Hello students, I am Malumi Akinapapaz. I'm your ACT 4-1 tutor, Financial Reporting and Regulatory Framework. The topic of today is Regulatory and Statutory Framework of Accounting. Let's get started. The following are the learning objectives of this course. One, we need to explain the need for a regulatory framework. We need to discuss the harmonization and globalization. Then we need to explain the structure of International Accounting Standard Board, IASB. Then we need to discuss how to set up International Financial Reporting Standard, that is IFRS. Then we also need to explain the conceptual framework, and finally, the scope of conceptual framework should be discussed. To start with, what are the needs for a regulatory framework of accounting? The regulatory framework is the most important element in ensuring that financial information are relevant, are presented faithfully to meet the needs of the shareholders as well as the users. The endpoint of every organization or every transaction in organization is the financial statement. And this financial statement is used by the users. So the financial statement prepared by an organization is for the consumption of what? Of the users. And who are the users of this financial statement? The investors, the creditors, the governments, the tax authorities, etc. By doing this, there should be a single body producing the financial reporting standard for financial statements and its framework. And the framework we are talking about is conceptual framework. Harmonization and globalization. In 2001, the IASC was replaced by IASB, which had a new structure of associated bodies and significantly increased the financial resources of the reporting entity. The IASC, that is International Accounting Standard Committee, issues IAS, that is International Accounting Standard. Presently, we have 41 International Accounting Standards. Then we have IASB, that is International Accounting Standard Board. The International Accounting Standard Board issues IFRS, that is International Financial Reporting Standard, but adopted all the relevant IAS issued by IASC. The need for harmonized financial reporting standard arises as a sort of the globalization of business activities. The harmonized financial standards are intended to provide wider investment choice, lower cost of capital, enhancement of business environment, and finally, more efficient capital markets. The structure of IASB. The structure of IASB are: 1. International Financial Reporting Standard Foundation, which comprises of 22 trustees. The IFRS Foundation are saddled with the responsibility of monitoring and funding IASB, IFRS Advisory Committee, and IFRS Interpretation Committee. Then we have IASB. IASB, that is International Accounting Standard Board, formerly known as IASC. They are saddled with the responsibility of issuing IFRS, that is International Financial Reporting Standards, and has adopted all IAS before the change of name in 2001. Then we have IFRS Interpretation Committee. The IFRS Interpretation Committee assists the IASB by improving existing standards. IFRS Interpretation Committees comprise of 12 members. Then we have IFRS Advisory Council. These are set up to participate in standard setting process. And we have Director of Technical Activities and Technical Staff. They are responsible for all the technical issues that may emanate from this issuing of standards. Setting up of IFRS. How do we set up International Financial Reporting Standard? The IFRS is developed through an international consultation process called the due process, which involves interested individuals and organizations. The due process comprises 6 stages, which the trustee having the opportunity to ensure compliance at various points throughout: one, setting the agenda, planning the projects, developing and publishing the discussion paper, developing and publishing the exposure drafts for the public to make their comments, and finally, developing and publishing the standard called the IFRS. Thus, the standard is issued for the public consumptions. Conceptual framework. So this is also an interesting topic part here. The conceptual framework is a statement of generally accepted theoretical principles which form the frame of reference for financial reporting, which in turn provides the basis for the development of new accounting standards and evaluation of those already in existence. Conceptual framework is not an IFRS and so does not overrule any individual IFRS. In case of a conflict between conceptual framework and IFRS, it is the IFRS that we prefer. Scope of conceptual framework. The following are the scope of conceptual framework. One, the objective of general purpose financial statement. The objective of general purpose financial statement is to provide information about the reporting entities for the users to make an informed decisions. Then we have underlying assumptions. We have 2 underlying assumptions in the financial statement. We have going concern and we have accrual basis. Under the going concern, every entity is viewed to be a going concern entity and they assume not to curtail their scale of operation. That is, the entities assumes that the entity must exist for a very long period of time. Then we have accrual basis. Every transactions should be assumed to have been what? To have been exist. Accrual basis simply means the income has been recorded not when they are paid. When the expenses should have been incurred, not when they receive. That's the accrual basis of what? Assumption. Then we have the qualitative characteristics of financial information in financial statements. We have 2 fundamental qualitative characteristics, that is relevance and faithful representation. Information is relevant if it will assist users in evaluating performance and position of the reporting entity. So relevant information should be able to make a statement that is in users making a difference in the financial statement. Then we have faithful representation. Information in the financial statement is faithfully represented if it reflects the true financial transactions that occur during the period. Information is faithfully represented if it complete, neutral and free from any material error. Then we have enhancing quantitative characteristics. One, we have comparability, verifiability, timeliness and understandability. Comparability: information in the financial statement should be able to be compared with the other entity. That is, information in the financial statement of the reporting entity should be compared with the other entity. Then we have verifiability. Verifiability: the information in the financial statement should enable different knowledgeable and independent observers to reach the same conclusion on the financial performance and position of the reporting entity. Then we have timeliness. Information in the financial statement should be presented in a timely manner. That is, the information in the financial statement should be time scaled. Then we have understandability. Information in the financial statement should be understandable in the sense that every users of the financial statement should be able to comprehend what is therein. The information in the financial statement should not be ambiguous to the extent that the users will not be able to comprehend what is inside the financial statement. Then another interesting scope of conceptual framework is definition, recognition, and measurement of the element of the financial statement. The financial statement is divided into two. We have statement of financial position and statement of profit or loss and other comprehensive income. What are the elements that we can find in the statement of financial position? We have assets, liability, and equity. Asset is the resources that is controlled by an entity as a sort of past event in which future economic benefit will flow to the entity. While the liability is a present obligation as a sort of past event in which future economic benefit will flow out of the entity. Then we have the equity. Equity is the residual interest after liability has been taken care of from the assets. So then what are the elements that we can find in the statement of profit or loss and other comprehensive income? We have revenue and expenses. Then the concept of capital and capital maintenance is the last scope of our conceptual framework. Details of the definition, recognition, and measurement of the element of the financial statement, as well as the concept of capital and capital maintenance, should be further discussed in the next chapter. Thank you for listening.